Welcome to your customized deep dive. Today we're looking at just a phenomenal stack of sources, and they really reveal this massive economic fault line, sort of running right through the global markets. You've got this incredible speed on one side, the AI arms race, and then on the other side, well, there's this heavy, constant friction. Geopolitics, regulation, basic consumer economics.
That's a perfect way to put it. It really is like watching two universes collide. You've got the AI universe generating, well, trillion-dollar valuations almost overnight, and then the reality universe is dealing with a government shutdown, tariffs making things shockingly expensive, and, well, a real estate market that it barely makes sense anymore in some places.
Right. So our mission today is to pull out the key insights from this collision. We want to understand how semiconductor competition is driving this huge infrastructure boom, why corporate giants are scrambling to reinvent themselves, and crucially, what the cost of all this political and regulatory friction actually means for, your daily life. Okay, let's start with the speed side. The foundation here is silicon, right? And we have breaking news. Qualcomm. They're making a really serious play to challenge the incumbents.
Oh, yeah. Big move.
They're jumping headfirst into the high-end AI accelerator chip market, taking on NVIDIA directly.
Which has, what, over 90% market share currently? And AMD, too.
Exactly. It's huge.
And look, this is more than just, another product launch. It signals a major shift. Qualcomm isn't just nibbling around the edges here. They're targeting the massive data center market, the projection. $6.7 trillion in capital expenditures through 2030.
$6.7 trillion. Wow.
Yeah. And their plan, with the AI 200 coming in 2026, the AI 250 in 2027, that shows real long-term commitment.
And what's really key here, I think, for you listening, is their focus. They're targeting inference.
Running the models.
Right. The process of actually running those already trained AI models quickly for millions of users. Not so much the pure high-power stuff needed for training the models initially.
Exactly. It's like the difference between building the factory and then optimizing the whole distribution network. Qualcomm's betting that the demand for running these huge models efficiently, it's about to explode.
Okay, but even running the models, you need someone to train them first, right?
Absolutely. Which leads us to the maybe surprising human engine behind this AI boom.
Right, the human infrastructure. And the numbers here are just staggering. Mercer, this AI hiring startup, its valuation just hit $10 billion.
$10 billion. After a $350 million Series C raise, that's a five-fold increase just since February.
Incredible. And it's a story of smart strategy meeting perfect timing, really.
Totally. Mercer specializes in recruiting these highly skilled professionals for AI training, data labeling. Think of them as the quality control engineers for the big language models.
So they're managing over 30,000 contractors now.
Yep. Over 30,000. And get this, they're paid collectively over $1.5 million daily.
Wow. That just shows the sheer scale of the human effort needed to kind of feed these silicon giants.
It really does, and their massive valuation jump. It came directly from a competitor basically stumbling. Mercer got a huge boost when Meta bought a 49% stake in their rival Scale AI.
Right, because the big AI labs, like Google and OpenAI, they got worried about neutrality.
Exactly. They essentially blacklisted Scale AI almost overnight. Mercer's co-founder had a great quote saying the competitor got torpedoed overnight.
Which just handed Mercer this massive pipeline of talent and clients.
Yeah, it really shows how fast value can shift and concentrate in this sector. And speaking of rapid value concentration, Tesla, and the pitch for Elon Musk's pay package.
Oh boy.
Ooh.
Nearly $1 trillion potential payout.
Well, Tesla's board chair, Robin Denholm, she's framing this whole thing not as a car company bonus, but as an AI leadership incentive. That's the angle.
The argument is basically Musk is the key. He's the one pushing Tesla beyond being just another car company. It's all about the AI focus. Full self-driving, the Optimus robots.
Right. But then you look at the milestones required to get that full payout.
Yeah, they're ambitious doesn't quite cover it, does it?
Not even close. We're talking an $8.5 trillion market cap goal.
$8.5 trillion.
Delivering 20 million vehicles a year, 10 million FSD subscriptions, 1 million Optimus bots delivered. These goals aren't just aiming for success, they're aiming for, total global market dominance. And it's all predicated entirely on delivering that AI vision.
Okay, so we've established AI can generate just instant, massive, almost unbelievable value. You've got Qualcomm's infrastructure play, Mercer scaling the human side, Musk's $8.5 trillion vision. But what happens when that speed, that relentless tech acceleration, slams head-on into, say, market saturation, or maybe more often government regulation.
Well, the collision is often.
Yeah.
Yeah, catastrophic is sometimes the word. And the best example right now might be iRobot, the Roomba maker.
Their stock plunged 33%.
Yeah, after the last bidder for the company just walked away. Left them in, well, dire straits.
And this isn't just bad luck, is it? This feels like the direct result of regulatory pressure basically grinding a deal to dust.
Absolutely. Remember Amazon tried to buy them for $1.7 billion last year?
Yeah, but the regulators pushed back hard.
Exactly. Intense scrutiny killed the deal. And now, iRobot has actually warned in a filing. They said there's substantial doubt about their ability to stay in business.
Wow, that's regulatory risk, literally deciding if a company lives or dies.
It's such a stark contrast, isn't it? AI infrastructure gets billions based on potential. Meanwhile, a company with proven consumer tech, real robots. It's being suffocated because it can't scale or find a buyer thanks to these geopolitical and regulatory hurdles.
Okay, let's pivot now. Let's talk about American Airlines. Here's a company struggling to adapt to a changing customer. The numbers comparing them to competitors are pretty shocking.
Yeah, lay them out.
First 9 months of this year, American made just $12 million in profit.
$12 million?
$12 million. That's only 2% of the combined profit of the 3 biggest U.S. carriers. Delta made $3.8 billion. United, $2.3 billion.
Ouch. American clearly misread the shift after COVID, didn't they? People didn't just want to fly again. They wanted a better experience, a luxury experience often.
Yeah, differentiated. So now AA is aggressively playing catch-up. They see that the premium travel boom is where the real profit margin is hiding.
Seems like it.
But is this a real transformation? Or are they just, reacting years too late? Delta and United were already moving this way.
Well, their plan includes some significant upgrades, cosmetic stuff like pouring Bollinger champagne in the top lounges.
Fancy.
And a major cabin overhaul, getting rid of first class entirely, actually, replacing it with bigger, better business class suites. So, necessary, but maybe reactive, like you said.
Yeah, but what's genuinely interesting, I think, is their tech leap. They're putting AI-driven features into their app.
How so?
So instead of just searching, New York to London, the AI lets you search for vacation themes like best wine tasting in spring.
Ah, okay. That's different.
It is. It's an admission, really, that the battle isn't just about routes and price anymore. It's about the digital experience, premium personalization, catching up there too.
So American is scrambling to adapt its product, its whole experience. Now, let's widen the lens. Let's look at maybe the biggest failure of systemic adaptation right now. The federal government itself.
Yeah, the macro pressures are really intense, and they all seem to point towards the economy stalling a bit. The big headline this week is the FOMC meeting. Markets are pricing in, 97% certainty of a rate cut?
Quarter-point cut, yeah.
25 basis points.
And that's driven by signs the economy is slowing down, and also a CPI print that was benign enough, let's say.
3.0% annual increase in September, which, by the way, was released late because of the government shutdown.
Right, and that shutdown, it's not just D.C. drama, it's a real economic break. The biggest federal worker union, AFGE, they're urgently calling for an end to it, a clean, continuing resolution. They point out 900,000 federal workers are furloughed, losing paychecks.
And beyond that immediate human cost, the shutdown actively hurts business, doesn't it? You've got this economic data blackout, makes the Fed's job harder. But think about small businesses relying on federal contracts or permits or even just routine data from agencies.
Total paralysis. It creates this huge level of uncertainty, regulatory friction across the whole private sector.
Friction, that's the perfect word, especially when we talk trade. Now, there is some optimism apparently ahead of the Trump-Xi meeting in South Korea this week.
Yeah, sources are suggesting maybe a trade deal framework is finally getting agreed upon. Maybe.
And the cost of this trade tension, it's become really personal for some high-profile people. Treasury Secretary Scott Bessent, he disclosed he owns soybean farmland up in North Dakota.
Oh, interesting.
And he actually said he has felt this pain himself from China's soybean boycott. He expects this upcoming deal, if it happens, will bring much-needed relief to American farmers.
So that's the view from the top, right? Relief for a major commodity. But for the average person, this friction, it shows up in the most ordinary places. Right. We have this pretty stunning example about the cost of tariffs on Halloween.
Wait, what? You're kidding. Tariffs are taxing our pumpkin carving.
They absolutely are. There's analysis showing pumpkin carving stuff, mostly made in China. They've seen year-over-year price hikes as high as 300% on some specific items.
300%. Like what?
Okay, get this. A basic decorative strobe light, little thing you put in a pumpkin, jumped from a list price of $1.62 to $6.99.
That's insane for a tiny plastic light.
Yeah, driven by underlying import tariffs around 60%.
That's just the ultimate example of macro policy causing micro friction right in your shopping cart.
Exactly. And retailers like Kohl's, they're reacting, launching holiday campaigns earlier than ever, trying to catch cautious shoppers, deal hunters who are watching every penny because everyday stuff is suddenly so volatile. And that volatility, that friction, it brings us perfectly to our final area of, well, massive divergence, the housing market. High cost of money, regional constraints, they're creating totally different realities depending on where you are.
And the data point out of Manhattan is just sobering. More than 1 in 3 Manhattan condo owners who resold between July 24 and June 25 sold at a loss.
A loss in Manhattan.
Yeah, and if you factor in a decade of inflation, transaction costs, the real pain is severe. The median price per square foot for Manhattan condos, essentially flat for the last 10 years.
It's such a paradox, isn't it? In a national market that's seen mostly relentless price surges, Manhattan seems to be suffering from high saturation, high operating costs. But also, those high interest rates are just crushing the mortgage market for most buyers.
Except for the very, very top.
Right.
The ultra-luxury segment seems immune.
Totally immune. Buyers and sellers of apartments over $10 million. They made double-digit profits. And they often used cash. 2/3 of the deals in the third quarter were all cash.
It just highlights how the super wealthy operate in this totally separate economy. They're just not affected by mortgage rates or the friction hitting the middle market.
Now, contrast that stagnation in Manhattan with some regional hotspots. Wyoming, surprisingly, saw the biggest one-year home value increase in the whole country.
Wyoming, really?
Yep, 5.17% increase. Bumped the median value up by about $18,000.
And this movement, it tells a pretty clear story about supply constraints, doesn't it?
Absolutely. Prices are rising fastest where it's hardest to build, the Northeast, New York, Connecticut, Rhode Island, all top 10, the Midwest too. Economists point to stringent regulations on building and density.
So friction again. It artificially constrains supply, drives up the price.
Exactly. And conversely, where supply has been added aggressively, prices are falling. Florida saw the largest home value decrease, down 5.13%.
Why Florida?
Well, it's a mix. Builders were rapidly adding supply in the Sun Belt, maybe overshot a bit. Plus, you have rising insurance costs, that's a big one. Driven by climate change risks, it adds this new, very real financial friction point to owning a home there. Hashtag tag outro.
Okay. Let's take a deep breath after that dive. We've covered a lot of ground. We saw the incredible speed and, frankly, the potential of AI infrastructure.
Yeah.
Qualcomm challenging the giants, the human capital boom at Mercer, Musk setting that $8.5 trillion target. It's all defining the future of capital spending.
Yeah, absolutely. And then we grounded that future with the, let's say, messy reality of right now. The fatal impact regulation can have, like with iRobot. American Airlines desperately trying to catch up with this digitally savvy luxury consumer. And the very real cost of macro friction, you see it in the price of a Halloween strobe light, or just the inability of the government to even function properly.
The central theme, really, across everything we looked at today is this constant struggle. A struggle to adapt to these new technological and geopolitical realities. The systems that govern our economy, supply chains, real estate finance, federal funding, they're clearly struggling, aren't they? Struggling to keep pace with tech acceleration.
They really are. So the crucial question we want to leave you with is this. As AI keeps driving this unprecedented technological and capital acceleration, can the analog systems, government, regulation, finance, systems that move at the speed of bureaucracy, the speed of geopolitical tension, can they truly evolve fast enough to manage the disruption, the extreme volatility this acceleration promises?
Or will the friction points we talked about, the shutdowns, the tariffs, the supply limits, just grow so intense that something fundamental has to break before the system can finally rebuild itself for this digital age?
That's the puzzle, something to think about.